And what we're just trying to do is we really make sure that we're catching your asset, your portfolio, and get it right in line in time with the insurance market. It's good to be back. It's been a few months working very, very hard to make sure that we're taking care of clients, the business is coming through the door, and we're coming up with new ways to ultimately do stuff better. But Jonathan Wee here, this time from the LA Epic office. So it's looking a little bit different, but we're still here trying to provide kind of the same content, really focused on the fields and the industries that we're working in, and then also coming up with new and unique ways to kind of look at things and keep it super informative and educational, so everyone can kind of take a little bit away from it, even if you know nothing about insurance and nothing about real estate.
What are the benefits of using a master insurance program for all of your assets?
We get this question a lot, particularly with our investors that are growing. They have assets and maybe they're in different cities, maybe they're in different states, and they have all these insurance policies. And so they're like, all right, well, is it possible that I put them under one policy rather than having multiple policies, 6, 7, 8, 9, 10, 11, 12, 20 for all these different apartment buildings? And the answer is certainly yes. Yes, you can. And in certain circumstances, it makes sense. That being said, I did want to kind of go over what we kind of see as the pros, but also the cons. So certainly some of the pros are going to be that by putting more assets together, more square foot, more multifamily space in terms of units, you are able to garner economies of scale. And this economies of scale means that you're going to have larger carriers willing to provide more insurance at a lower cost. Now, what this does mean is that you're effectively going to have to then provide more information up front. This means you're going to have to put together what's called a statement of value. So this is going to be the doors, the addresses, the construction type, right? You're going to have to fill out all these applications, and it's going to take more work up front, but ultimately what it can mean is that you're going to have better coverage, better pricing, and a product that's much easier to manage in the long run. That being said, you can face the exposure of having one claim at one building that might be slightly large. That could really impact the overall profitability of that insurance policy to that carrier. And then you might face rate pressure and premium pressure at all these different locations because of one bad app. So these are just kind of the factors that we're always trying to take into account. And one of the things we do want to keep in mind is that, putting things on a blanketed policy versus doing one-off policies for individual assets. The other way to look at it is that sometimes there are a lot of carriers who are out there willing to provide a lot of insurance on the blanketed basis. So you have carriers that are willing to provide those cheaper rates at lower premiums. But then essentially sometimes in the market, the premium swings back and you have more carriers individually on a regional or local basis that want to provide good rates and good terms to local and smaller assets by themselves. And so we're always kind of in this pendulum swing back and forth. And what we're just trying to do is we really make sure that we're catching your asset, your portfolio, and get it right in line in time with the insurance market.
Other than just getting a quote, are there other ways to get insurance for a new acquisition?
As you kind of move up in scale or, as you look to potentially build out your portfolio, right, there are other ways to look at getting insurance. Obviously, you buy asset and you say, hey, let me find an agent, typically is what we see. But you could look at someone like your property manager, right? If you're using a larger property manager, do they have their own portfolio? Are they providing insurance for some of the assets that they manage? This is going to allow them to have a different type of scale that maybe you don't have as an individual investor. Additionally, you could look at someone like a JV partner. Are you going in with a JV partner who has 50-50 control? Are they able to provide insurance based on the rest of their portfolio? You could also potentially look at getting insurance through a limited partner, limited investor who is investing in a lot of separate assets. Typically, the limited partner can also have a certain amount of economic scale, which could potentially help you when you look to get better terms and rates and coverages for your asset. And then finally, you have the option of taking a look at what apartments you do have and saying, hey, is there any way that I can roll this apartment, this industrial building, this office building into another insurance policy that I have for a very similar asset that I already own. And by doing that, you can hopefully take advantage of the better rate on that insurance policy and potentially pick up more scale and better coverage by putting them together.
What is a loss limit on property insurance?
What you're essentially doing is saying, hey, I have 10, 20, 30 different assets at different locations. And what I want to do is, rather than buy property insurance for the total insurable value, what I want to do is take a look at the maximum probable loss, which is the largest loss that I could potentially have based on the concentration and based on the exposure of those assets, rather than buying that 300, 400, 500, 600 million total insurable value policy. What I'm going to do is then lower that number to that maximum probable loss and say, just because I have 2 buildings downtown in downtown Fort Worth, that, I'm just going to insure these assets up to the total value of those. And that's the maximum loss that I'm going to have. So what we're going to do is make that a loss limit. So rather than buy that 400 million, we're going to buy a policy that is then 60 million or 50 million. And what this is just looking at the maximum probable loss. And the thing to keep in mind is there's still a per occurrence policy. So not only are you able to get the benefit of having that limit to insure up to that total amount, you also have it on a per occurrence basis. So that is something that can reinstate if you have multiple losses. So there's no general concern that that amount is going to be wiped away by one single claim.
Does your profit and loss matter for property?
I've seen a lot of brokers and consultants online kind of talking about this idea that your profit and loss, which is your internal P&L, is something that is dramatically going to impact how your policy is rated, whether you're provided coverage, and at what price. Now, certainly, as someone has spent 10 years on the underwriting side with AIG, Chubb, and then Zurich, this is something that was tracked when I was in middle market, national casualty, and also small business. So it is very much something on an individual basis that's being taken into account. So you as an investor or not-for-profit that has 10, 20, 30, 40, 50 buildings, yes, they are going to take a look at how much premium are you paying versus what is your loss, because that's how insurance companies make money. At the same time, generally, the large majority of clients who are buying insurance are not going to be impacted by their profit and loss, but a lot more about the risk factors and how that risk factors and how their exposures that they're facing, whether geographically, whether by the vintage of their asset, whether by who's leasing the building, these features, it's really about how that meshes with what the underwriting guidelines are for that carrier at that particular time, based on how their overall portfolio is performing. And that's going to play a much larger role in how it gets underwritten, whether that be rate increases, declinations, cancellations. All of this is much more internally driven based on how the individual company is performing.
In what situations does it make sense to turn in a property claim?
All claims are really unique, but one thing that kind of tracks across industries, across insurance policies, is that whenever a claim does come up, anything that looks like a civil suit, any slip and falls, any letters from attorney, any kind of property damage, what we always want to do is have a really quick conversation with our insureds and with your broker and say, hey, this is what's going on. This is what we have. It's a property claim. We want to make sure that we're mitigating this, making sure we don't have further damage caused. We want to really encapsulate that. If there's a leakage, stop the leakage. If there are individuals or tenants, we want to get the tenants out. And then we quickly want to get someone out there that's going to take an assessment of how much it's going to cost to fix the problem. And part of our job is working with our business owners to say, hey, based on what your deductible is and based on who your insurance carrier is and how much you're paying in premium, does it make sense for us to turn in this property claim? Because liability claims, generally, we always want to hear about them, regardless of what the deductible is. There's a burden on us and on our owners to make sure that we're letting the company and the insurance company know as soon as possible, because they have to get claims adjusters involved and we have to prepare for legal defense. Now, we're talking about strictly property. What we're going to help you do is do an assessment based on what is it going to cost to fix the problem, what's the deductible, and what's the appetite of our insurance company to continue to provide insurance for us in the future, and based on what rate. Because we don't want you to get canceled, and we don't want you to turn in an insurance claim that's probably going to sit under the deductible.
Why is it critical to let your broker know about a claim as soon as possible?
Across the board, whenever you do have something that looks like a claim, I think the immediate communication is necessary. Now, when we're talking about liability suits, that's even something that's more necessary, right? You have something that occurs where someone slips and falls, or two people get in a fight while on your site. So you have a fire, and that involves tenant. All of these things involve some kind of legal defense because someone's going to bring suit against you. And what's critically important is that we meet the notice requirements for the carriers so that we can get that claim acknowledged. Because if we wait too long and we sit outside of the window, then it's potential that the insurer will not recognize. On top of that, right, you're going to eventually receive these legal letters from attorneys. And what we want to do is make sure that we have the claims team, claims adjuster, and potential legal counsel prepared as soon as possible to be able to respond to this so that we're meeting all the deadlines that need to be met. Because oftentimes, if you don't respond to letters from plaintiffs during civil suits in a certain period of time, what that's going to lead to is several penalties. Penalties can come up very quickly, and attorneys don't move very quick. So what we want to do is make sure we get the claims team involved as soon as possible so that we can keep them accountable. And then as we work through the suit, what we really want to do is utilize Epic's team to really push both parties to either come up with a resolution for the insurance payer to pay the claim or to have there be some kind of mediation.
What is a loss control inspection, and how should I manage or prepare for one?
More and more, I know owners are becoming comfortable with the idea that once they bind their insurance, it used to be a set it and forget it type of item. However, now insurance carriers, they have AI, they have access to drones. There's a lot better information online. And so not only are they able to get in there and see how this building or buildings looks online, but it means that if something does trigger them, they're that much more inclined to then send someone out to go take a look at it in person. And I'd say nowadays this is happening to 80% of my clients. Once they bind their new insurance, there's going to be some kind of inspection. And historically, this wasn't something that was really taken into account. A lot of agents didn't necessarily go during the visits, and it was seen as something that was kind of a run-of-the-mill process. However, now, what ends up happening is that if there aren't good results for this loss control visit by the carrier, which means the carrier is going out and making an assessment of this building to provide feedback to their underwriters, if there isn't great feedback, this can certainly come back as something that can hurt them in the renewal or can cause a cancellation. So what I do with my clients is make sure that as these loss control visits come up, I'm being communicative with my clients and also the loss control specialist that's going to be out on site, and making sure that when we do show up, we're very specific as to exactly what the loss control professionals want to see, what they expect, and what are the expectations from my client side as well. Because we always want to make sure our client is shown up in the best possible way. What our job to do is not only advocate for our client, but to make sure that expectations are met from the carrier side and things don't go overboard and they start reaching and looking into exposures that are either not relevant or haven't been brought up to give our client a chance to prepare for this. Because the more information that they're erroneously given, the more it can be used to potentially damage the renewal. And so what I like to do is really control how and help our clients control the narrative so that the narrative really aligns with what was submitted and who my clients are as an insured. So the carrier understands the picture, they understand the operations, what we're trying to accomplish, and ultimately it becomes much more helpful to our clients because the carrier is able to provide recommendations that will not only help them operationally, but will help them from a risk standpoint and ultimately make them a better client.
Why is insurance a critical part of operating an investment?
As I see myself as not only an individual that really works in insurance, but also someone that actively manages tenants through rental property, it's become very applicable to me to look at this as not just a business that I kind of advise, but also a business I'm in. And one of the things that has become really clear to a lot of investors within my circle is that ultimately, depending on what your disposition is, if you're a private investor, your IRR that you're promising to someone, whether it be an LP or a syndication or family investors or at a family office, how your NOI is impacted is by expenses and by revenues. right? And what we can do, we know that impact NOI, net operating income, are the revenues and the expense. And the demand for apartments is supply side driven. We can only get a certain amount of rents from our tenants. So what we can do is really look at our expenses and think about, all right, how are we operating this asset? And then what factors are going to either help or hurt my NOI based on that. And one of the main expense items that have now jumped from what used to be a 1% of the total value of the asset to like a 2 or 3 now is the insurance, right? And how that ultimately impacts the NOI, then that NOI, that very compressed NOI, because of the higher expenses from the insurance, what that ultimately does is then hurt the value that we're able to sell the asset for at our 5, 7, 10-year disposition. So for us to really be able to maximize that NOI and get more out of this asset during sale and to provide more money for our investors, what we have to do is really be diligent about that cost, because that cost is what's ultimately going to impact our value and it's going to impact our return. And a lot of times that impact is becoming much more sizable.
What are net leases and how do they impact insurance?
Yeah, the net leases is certainly something that impacts our retail, our industrial clients, and sometimes some of our office clients. But how we typically see the net leases play out from an insurance standpoint is our owners and our lessors of their building, they are going to look at the lease, potentially whether you be a restaurant who's leasing the building, or whether you're a manufacturing operation, or whether you're a construction operation, and they're going to say, you know, based on your exposure and based on how you are impacting my overall expenses and insurance costs, what we're going to do, including utilities, what we're going to do rather than provide the insurance and buy the insurance for the building, we're going to make sure that in our lease, there's a requirement that you will buy the insurance for this space. And by doing that, they're pushing that cost down to the individual tenant. In some cases, that's certainly warranted, where let's say the exposure is high and there's a potential for a fire, or you're doing something rather unique in the building that's going to drive up the cost. And so by the owner making the lease net, they're able to push the cost for the individual building or the space down to the individual that's using it, right? And in some cases, that makes it a lot more applicable and it's making it more personal to the actual risk that the asset faces, as opposed to the owner who's not actually using the space. Now, this can be helpful if you are the owner, particularly if you have tenants that are going in that have riskier operations. This can be something that's very beneficial for you, because it's really nice when you are facing these very low and potential marginal insurance costs. But if you move in someone that has a higher risk exposure, like a restaurant, the restaurant or the tenant is the one who's going to be purchasing insurance. And it's much better placed in the individual that has the risk or the group that has the risk, while you as the owner aren't necessarily able to impact that. Now, when it can be challenging is if in the case that you are the tenant, and maybe you're a smaller tenant and you don't have the capacity from an insurance side to pay what the property insurance should cost in that building based on your operation. That's when things kind of get tough. And a lot of this is going to come down to the strength and the influence of either parties in this contract, and this is going to be a contractual item. This is just something we want to keep in mind when we're the owner of the building, or whether we are looking for new leased space, and just kind of keep that in mind.
Between real estate and insurance, what is your personal preference and why?
I've always had an affinity for insurance. Spent 10 years on the underwriting side and now going 4 years as a broker. And I certainly love the technical elements and also the social elements of working in insurance. But I think from an owner side, having more control of my financial outlook and being a little bit more dynamic and really being able to get into the microeconomics and also the macroeconomics of real estate, I think is really fascinating. So I really appreciate everything that both industries bring to the table. And ultimately, I try to be that bridge between the owner that sees himself as a small business or a large business as an investor, and the insurance company, which is also generally this mega capitalized conglomerate. And so I generally think that I'm able to cross the bridge between those both worlds.
What initially drew you to real estate or inspired you to work in the field?
Growing up in Oakland and Richmond, California, I think you have an appreciation for the spaces you live in and the communities you live in. And oftentimes the financial incentives and the mechanisms that kind of create that community and create those spaces are something that seems really abstract to you. So you don't necessarily know who owns the Oakland A's Coliseum when you're a little boy and you're sitting in the field, right? But in the back of your mind, you're always wondering, who owns this? Why is this here? Right? Or when a new restaurant pops up, or when there's a new mall development, right? You're wondering, well, this is great. I love this space. But as a little kid, I always wanted to know what that meant for the community, who owned it, and what were the decisions that created that, right? Because that also impacted myself, my family, and my friends. And so I think that's what I love most about it, is just being able to understand how spaces are created and being a part of what makes great spaces that create and house community and culture and allow, our next generation to really thrive.
What initially drew you to real estate or inspired you to work in the field?
Expenses for me is something I'm still hyper aware about. I really like the idea as an individual that my full-time income doesn't come from real estate. I really like the idea that I'm able to write off and deduct tax appreciation, interest, a lot of the expenses that are going into my investments. And so that's a huge, huge incentive for me. Now, that doesn't take away from the fact that I really like the assets to cash flow. And then ultimately, I want to be net cash positive. Now, that may not always be possible, but I can't put myself in a position of being in such a deficit that this tax incentives and the long-term outlook don't look positive or beneficial. And so I think that's what I've become hyper aware of, is just looking at what are my expenses? Like what's my P&L on this asset, and where are my expenses going now? Where are my rents going? And then how is that NOI going to be impacted by some of these expenses based on the vintage of the asset, based on the renovations that need to be done, the life of some of the investments that I'm in? I really start to question whether it might make sense to transition us to newer assets and newer buildings, just because of the cost of the upkeep and renovation. And to mitigate those expenses, it's just becoming more costly.
Thank you, Jonathan. This Beyond Insurance conversation has been beyond insightful.
Beyond Insurance, insurance that covers you beyond your needs.